March 2023, Silicon Valley Bank collapses. Headlines scream about a $200 billion failure. But while the world watched one bank die, the entire U.S. banking system quietly hemorrhaged 10 times that amount. The real story wasn't in a boardroom. It was on page 1 of a weekly Federal Reserve report almost no one reads. According to the Fed's H8 data, the total assets of all U.S. commercial banks fell by over $800 billion between March 29th and June 28th, 2023. But that's merely the net number, the devastated ending balance. The gross outflow of deposits was closer to $2 trillion as money surged out. More critically, when you account for what didn't arrive, the new loans that weren't made, the deposits that didn't grow, the total hole punched in the banking system, its growth trajectory was a staggering $8 trillion in foregone balance sheet expansion. This is the phantom capital that vanished from the system's future. The media narrative was crisis contained. The cold data said contagion achieved. This was not a traditional panicked bank run broadcast on CNN. It was a systemic seepage, a silent, calculated, and wholesale exit executed by the smartest and largest pools of capital in the world. Corporate treasurers, institutional funds, and wealthy individuals. They didn't run to another bank. They ran from the banking system itself. This raises the critical, unanswered question. Where did $8 trillion in potential banking activity go in just 90 days? And why does its disappearance signal that the fundamental rules of American finance changed forever in the spring of 2023? To find the answer, you must follow the trail of the most risk-averse actor in the global economy, the corporate treasurer whose single decision unlocked the floodgates. The post-SVB exodus was not a classic panic. It was a cold, rational reassessment conducted in spreadsheets by professional money managers. The data proves the run was almost entirely institutional. The FDIC's quarterly banking profile reveals the stark divide. In the second quarter of 2023, uninsured deposits, those over the $250,000 guarantee threshold, held primarily by businesses and institutions, plummeted by over $500 billion. Meanwhile, insured deposits, held by Main Street savers, remained essentially flat. The hemorrhage was precise, targeted, and executed by those with the most to lose and the sophistication to act. This triggered a historic flight to quality, but not merely to bigger banks. Trillions flowed to the perceived safety of global systemically important banks, GSIBs, like JP Morgan Chase. Even more consequentially, capital fled the traditional banking system entirely. For a corporate treasurer managing a $50 million cash pile, the post-March calculus was irrefutable. Why leave it in a regional bank earning 0.5% interest with even a 0.1% perceived risk of failure when you could park it in a Treasury-only money market fund, yielding over 5% with the implicit backing of the U.S. government and zero credit risk? This was not emotional panic. It was optimal cash management. The Silicon Valley Bank failure was not the root cause of the outflow. It was the catalytic event that revealed a brutal new financial truth. For large-scale institutional cash, the traditional commercial banking system had become an inferior product, offering lower yields and suddenly higher perceived risk than alternatives directly plugged into the Federal Reserve. The documented political and media narrative of an isolated incident at a few niche banks collapsed against the verified data of a wholesale, systemic reallocation by the world's most sophisticated capital allocators. This reallocation didn't just move numbers on a ledger. It activated a dormant, multi-trillion-dollar piece of financial plumbing the Fed itself had built, a mechanism that would begin to operate in reverse, with devastating consequences for credit creation. The primary destination for the $8 trillion in fleeing banking activity was not a foreign shore or a hidden vault. It was a digital facility at the Federal Reserve of New York known as the reverse repo, RRP. This mechanism, designed for monetary control, became a multi-trillion-dollar risk-free vacuum, sucking liquidity directly from the commercial banking system. Here's the mechanism. The RRP allows eligible institutions, primarily money market funds and government-sponsored enterprises, to deposit cash overnight with the Fed in exchange for U.S. Treasury collateral, earning the Fed's set interest rate. It is the ultimate safe, liquid asset, a deposit at the central bank itself. In the 90 days following the SVB collapse, RRP balances hovered persistently above $2.2 trillion, acting as a gravitational sink for institutional cash. Every dollar parked in the RRP was a dollar not sitting in a commercial bank deposit. As a 2023 Federal Reserve research paper concluded, the RRP, created for stability, became a destabilizing force for bank funding during stress by offering a superior zero-risk alternative. The irony is profound. The Fed spent the decade after the 2008 crisis building tools like the RRP and interest on reserve balances, IORB, to better control short-term interest rates. In 2023, those very tools accelerated the silent bank run by providing a frictionless, high-yielding escape hatch. The Fed had unwittingly become a direct competitor to, and was decisively beating, its own regulated banking sector. The data provides irrefutable proof. Plot a simple chart of RRP balances against commercial bank deposits for spring 2023. They are a perfect inverse correlation. As RRP balances held firm above $2 trillion, bank deposits plunged. The money didn't disappear. It simply moved 100 yards down the street from Bank of America as ledger to the Federal Reserve's digital vault. The RRP was the immediate landing pad. But the money didn't stay inert. It became the fuel for the rapid, alarming rise of a parallel, less regulated financial system that now operates in the shadow of traditional banking. The $8 trillion bank exodus did not enter a void. It triggered a massive systemic reawakening of the shadow banking system, the network of non-bank financial intermediaries, NBFIs, that now rival traditional banks in scale and influence. The flow was direct and transformative. Follow the money. Corporate deposits fled Bank XYZ for the safety and yield of a government money market fund. That fund, in turn, parked a massive portion at the Fed's RRP facility. But crucially, a growing share of that institutional cash was also channeled into private credit funds, direct lending platforms, and other NBFIs that lend directly to companies, completely bypassing the traditional banking system's balance sheet and regulatory framework. The data confirms this structural shift. Assets under management in private debt funds soared to new records in 2023, surpassing $1.5 trillion globally. This explosive growth was directly funded by the torrent of institutional cash-fleeing, low-yielding, suddenly risky bank accounts. The 2023 banking crisis was not an isolated event. It was the catalytic tipping point for a 40-year trend of financial disintermediation. Banks had been gradually losing their monopoly as essential financial middlemen due to technology, fintech lending, and post-2008 regulations, Basel III, that made traditional lending less profitable. The great deposit flight of Q2 2023 was the final decisive shove. This creates a fatal new reality for the old banking model. Consider a mid-sized company needing a $100 million loan. In 2013, its CFO went to JP Morgan. In 2023, its private equity owner arranges the financing through a consortium of private credit funds. Those funds, in turn, are capitalized by institutional cash, which, ironically, includes the very corporate cash deposits that left banks like JP Morgan in the first place. The circle is closed, efficient, and lucrative. The traditional bank is entirely cut out of the transaction. Therefore, the $8 trillion exodus was not a temporary panic to be reversed. It was a permanent capital migration from a regulated, fragile, and low-return system, traditional banking, to a less regulated, higher-yielding but more opaque system, shadow banking. This migration immediately triggered a silent, second-order crisis that is still metastasizing on the balance sheets of every regional bank in America, threatening their very reason for existence. The $8 trillion exodus inflicted a crippling, lasting wound on the banking system. The collapse of net interest margins, NIM, the core engine of bank profitability. The mechanism was a vice. Banks were forced to pay soaring short-term rates on deposits to prevent further flight, while their earnings were locked into long-term loans and securities booked during the era of near-zero interest rates. As cheap deposits vanished, they had to replace them with expensive certificates of deposit, CDs, offering 5% or more, brutally squeezing the profit from every loan on their books. The FDIC's data confirms the devastation. The aggregate net interest margin for all U.S. banks peaked in the first quarter of 2023 and then fell sharply throughout the year. For many regional banks, the decline was catastrophic, erasing profitability. This pressure was intensified by the held-to-maturity trap. Banks couldn't sell their loss-ridden Treasury bonds to raise cash without realizing apocalyptic losses, so their only recourse was to beg for new, high-cost deposits. The inevitable consequence was a credit crunch. With their core business model, borrowing low, lending high, fundamentally impaired, the only rational response was to stop lending. Federal Reserve H8 data shows commercial and industrial loan growth stalled in mid-2023 and then turned definitively negative, contracting for the remainder of the year. The $8 trillion in foregone banking activity translated directly into a multi-billion-dollar reduction in credit available to American businesses. The stock market immediately capitalized this permanent impairment. Regional bank stock indices, like the KBW Regional Banking Index, collapsed over 40% in the 2 months following SVB and never recovered, trading a third lower by year-end. The $8 trillion in lost future balance sheet expansion was crystallized into over $500 billion in vaporized market capitalization. This starkly contrasted with the documented public assurances from bank executives of strong underlying fundamentals. The verified data revealed a permanent fracture in their economic model. Regulators, watching this slow-motion death spiral unfold, recognized the systemic threat. Their response in the summer of 2023 was a desperate, thinly disguised bailout that quietly rewrote the rulebook to prevent an avalanche. Facing a systemic death spiral in March 2023, regulators executed a critical, underreported rescue, the Bank Term Funding Program, BTFP. This was not a bailout in the 2008 TARP mold of direct equity injections. It was a more subtle yet massive regulatory life support system that allowed banks to survive the $8 trillion exodus by temporarily suspending financial reality. Announced on March 12th, the BTFP allowed banks to borrow cash from the Fed for up to 1 year. The revolutionary and controversial term was the collateral rule. Banks could pledge their treasury bonds and mortgage-backed securities at their original par value, not their deeply depressed market value. This allowed them to tap nearly the full face value of assets that would have incurred catastrophic losses if sold, effectively hiding the unrealized losses plaguing their balance sheets. The scale of its uptake reveals the depth of the crisis. Usage soared, peaking at nearly $165 billion by mid-2023. This sum was not marginal liquidity. It was a direct stealth capital injection that enabled dozens of banks to meet relentless deposit withdrawals without triggering the fatal fire sale that killed Silicon Valley Bank. This constituted a profound regulatory subsidy. Unlike TARP, it didn't use congressional appropriations, but it allowed the banking system to operate on an accounting fiction, pretending assets were worth more than the market dictated, and borrow against that fiction. It was an elegant fix for a looming solvency crisis disguised as a liquidity problem. Analysis of the borrowers confirms its true purpose. The largest users were not the globally systemic megabanks, which had other funding sources. They were the regional and super-regional banks, exactly those sitting on the largest held-to-maturity HTM security losses. The BTFP was a bespoke life support system for the very business model, borrow short, lend long, that had been broken by the Federal Reserve's own aggressive interest rate hikes. The program created a dangerous dependency, which came to a head on March 11, 2024, when the BTFP stopped issuing new loans. Banks that had grown reliant on this Fed-funded crutch now faced the original unresolved dilemma. They must either attract prohibitively expensive new deposits or finally sell assets at steep losses to repay the Fed. The cure is being withdrawn while the patient remains weak. The contrast between the documented political narrative of no bailouts and the verified reality of a $165 billion novel facility that prevented potentially dozens of sequential bank failures could not be more stark. The system survived 2023, but the patient was left chronically ill, hooked on temporary support. The diagnosis for 2024 and beyond is a permanently smaller, weaker, and more fragile banking system, operating on the edge of a renewed liquidity crisis. The 2023 exodus did not end with a return to normal. It permanently redrew the map of American finance, creating a more concentrated, fragile, and bifurcated system. First, the bigger get bigger. The crisis accelerated a decade-long trend. Global systemically important banks, GSIBs, like JP Chase, absorbed a significant portion of the fleeing institutional deposits, emerging with even greater market share and power. The gap between the top 4 banks and the rest of the industry widened irreversibly, increasing, not decreasing, systemic concentration risk. Second, regional bank zombification. Hundreds of regional banks are now trapped in financial purgatory. They are structurally uncompetitive in attracting deposits, burdened by low-yielding legacy assets, and are reliant on volatile, expensive funding. Their core business model is impaired. They cannot grow. Their future options are limited to managing a slow decline, selling assets, or seeking merger partners to survive. A wave of consolidation that has already begun. Third, the shadow bank ascendancy. Private credit funds, direct lenders, and fintech platforms have been fully legitimized and supercharged, now funded by the very institutional cash that deserted traditional banks. This parallel system operates with less regulatory oversight, higher leverage, and without the backstop of deposit insurance. The systemic risk has not been eliminated. It has simply migrated into a more opaque and interconnected shadow. Fourth, the Fed's inescapable dilemma. The Federal Reserve now understands with painful clarity that its own post-2008 tools, the reverse repo facility and interest on reserves, can actively destabilize the banking sector they were meant to regulate. Furthermore, any future rate cuts intended to relieve pressure on banks will also lower funding costs for their non-bank competitors, making shadow banking even more attractive. The Fed is caught in a trap of its own sophisticated design. The documented surface-level return to normalcy in late 2023 masks this verified deep structure transformation. What occurred was not a blip. It was the violent culmination of every financial trend since the 1980s: deregulation, disintermediation, and the dominance of shareholder primacy. The 2023 data is the tombstone for the era of traditional banking's unquestioned supremacy. The 2023 Exodus provides an autopsy report for the modern bank run, revealing 4 core principles that have permanently altered financial stability. Principle 1, speed kills, digitally. The iconic image of a Depression-era run, a physical queue of panicked depositors, is obsolete. The contemporary run is a corporate treasurer authorizing a $500 million wire transfer in seconds via a digital portal, or a hedge fund redeeming a sweep account with a click. Digital infrastructure has made systemic runs instantaneous and borderless, compressing a crisis that once took weeks into hours. Principle 2, deposits are not sticky. They are hot money. The foundational assumption of a stable, loyal deposit base is dead for institutional and large balance accounts. These deposits are now performance-seeking, highly rate-sensitive capital allocations. They exhibit the volatility of wholesale funding, but sit on the balance sheet as deposits, creating a dangerous illusion of stability that vanishes the moment a higher-yielding, perceived, safer alternative emerges. Principle 3. Regulation creates its own shadow. Post-2008 regulations like Basel III made traditional banks safer by imposing higher capital and liquidity requirements. A critical unintended consequence was making core banking activities less profitable, which systematically pushed lending, trading, and maturity transformation into the less regulated non-bank financial sector. The regulation solved risk in one area by proliferating it in another, less visible one. Principle 4. The central bank is now a competitor. By creating and offering massive, risk-free, high-yielding assets like the reverse repo facility, the central bank can inadvertently become a superior alternative to commercial bank deposits. During stress, this acts not as a backstop, but as a vacuum, actively draining liquidity from the very system it is mandated to support. The lender of last resort has become a competitor for first-choice funds. As former FDIC Chair Sheila Bair warned in 2023, we have moved the run risk from the retail deposit side to the wholesale funding side, and it's faster. These principles explain why the next crisis won't resemble 2008's interbank freeze, or even 2023's regional bank tremor. It will be faster, more digital, and centered in the vast, interconnected shadows of the financial system where these principles now reign supreme. The 2023 Exodus was not an isolated event. It was a stress test, whose results now define the clear and present dangers for 2024 and 2025. The vulnerabilities it exposed are not healed, they are ticking. The parallel? Commercial real estate, CRE. The deposit flight crippled the primary lenders, regional and community banks, which hold approximately 70% of all CRE loans. As an estimated $1 trillion of these loans mature in 2024 or 2025, these weakened banks are often unable or unwilling to refinance them at today's higher interest rates. The $8 trillion exodus didn't just shrink banks. It shattered the financing engine for office towers, shopping malls, and apartment buildings, creating the fuel for a self-reinforcing CRE crisis, the BTFP cliff. The Bank Term Funding Program, the $160+ billion lifeline, expired for new loans in March 2024. Banks that relied on it must now repay the Fed or roll that funding into far more expensive market alternatives. This forces an impossible choice: attract costly deposits or sell assets, potentially those very same CRE loans or loss-ridden securities, into a distressed market, triggering the losses the program was designed to avoid. The unrealized loss time bomb. The banking system's unrealized losses on investment securities remain near $700 billion, a direct result of the Fed's rate hikes. These losses are only unrealized as long as banks are not forced to sell. The next wave of deposit volatility, sparked by any new shock, could trigger the very asset sales that would crystallize these losses into catastrophic hits to bank capital, eroding their ability to lend and survive. The critical warning. The system is now stable only in calm markets. The $8 trillion exodus proved its latent digital age fragility. The next catalyst, whether a mild recession, a major CRE default wave, or a geopolitical event, will strike a financial system with fewer shock absorbers due to weaker bank profitability, less liquidity due to the BTFP expiry, and more hidden, interconnected leverage in the unregulated shadow banking sector that grew from the ashes of 2023. This creates a stark contrast between documented regulatory assurances of strength and resilience and the verified data showing a system with heightened specific vulnerabilities to the next inevitable stress event. For depositors, investors, and policymakers, the forensic lessons of those 90 days in 2023 are not historical anecdotes. They are an urgent manual for the next financial emergency, which is already taking shape in the silent refinancing calendars of America's commercial real estate. The $8 trillion exodus was a brutal market referendum on the traditional bank. The verdict is final. For institutional capital, it is an obsolete savings vehicle. The migration to shadow banking is permanent, demanding a new rulebook for all financial participants. For corporations and institutions, treat your cash as a strategic portfolio. Allocate it across multiple banks, staying under FDIC limits per institution, direct treasury holdings, and government money market funds. Banking is a utility for payments and operations, not the primary repository for corporate savings. For retail depositors, the FDIC's $250,000 insurance limit is your sole non-negotiable protection. If your savings exceed this, spread them across different insured institutions. Understand that your bank's health is now explicitly tied to interest rate moves and its exposure to commercial real estate, factors worth monitoring. For investors, the traditional regional bank equity model is broken. The future of financial returns lies in asset managers like BlackRock, private credit funds, and the technology platforms that disintermediate traditional lending, not in betting on a revival of net interest margins. For policymakers, stop attempting to resuscitate the old model. The urgent task is to rapidly expand the regulatory perimeter to encompass the shadow banks, private credit, money market funds, and fintech lenders, where systemic risk is now concentrated before the next crisis erupts there. The final verified insight is this. The Federal Reserve's H8 data for Q2 2023 is the single most important chart in modern finance. It doesn't depict a panic. It documents a permanent structural shift. The $8 trillion didn't return. It found a new home. The American banking system, as the primary engine of economic growth, is a relic. Therefore, the call to action is analytical. Don't just look at your bank's app. Look at the Fed's weekly H8 release. Watch the total assets of commercial banks line. When it begins a sustained descent, you'll know the next chapter of the great exodus has begun long before the headlines announce it. In finance, the most critical events are never announced. They just appear, 1 week at a time, on page 1 of a PDF almost nobody reads.